All I can tell you is I think Bitcoin is extremely cheap on a number of metrics. And I'm comfortable buying it at 30,000 because I think that it is so darn cheap. And, you know, I use one model that uses credit default swaps. I can use another model that values Bitcoin at over $2 million in today's dollars.
Popular Bitcoin advocate Greg Foss says there's a very high probability that Bitcoin, the world's leading cryptocurrency, becomes a multi-trillion-dollar asset class in the not-too-far future. According to Foss, who currently serves as the executive director of strategic initiatives at Validus Power Corporation, there are a number of metrics that show that Bitcoin is extremely cheap at its current price. One of those metrics is pricing everything in Bitcoin, even fiat currencies like the US dollar, instead of the present system of pricing Bitcoin in dollars. Another metric is using Bitcoin as credit default swaps against sovereign debt. As each nation's debt increases to infinity, so does the intrinsic value of Bitcoin. But perhaps the most interesting and straightforward metric is one that considers Bitcoin's current share of the total global financial assets. According to Foss, Bitcoin's current market cap of just above $520 billion is just a tiny percent of the $900 trillion total global financial assets. As more people diversify away from other asset classes like bonds, which Foss describes as the dumbest investment, to Bitcoin, the former risk manager believes that tiny percent will begin to climb until Bitcoin is trading at $2 million per coin. Foss details his prediction for the leading digital asset in a recent interview with Kitco News. During the discussion, the Validus Power executive director also talks about fiat currencies and why he believes all fiat currencies are programmed to debase steadily and eventually collapse. Foss uses the example of the United States dollar, which despite being the world's reserve currency, a status it has held for several decades, continues to lose its value rapidly. On the other hand, you have Bitcoin, the world's best store of value based on math and code that cannot be manipulated by any central authority. Foss says it's a no-brainer that the leading digital asset will outlast all fiat currencies and perform much better than other assets in the long term. We will now bring you clips from Foss' discussion with Michelle McElroy, Kitco's lead anchor and editor-in-chief. Ensure you watch the video to the end, subscribe to the channel, and smash the like button. Lastly, don't forget to drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So I can use another model that values Bitcoin at over $2 million in today's dollars.
Is that going back to bonds?
It is bonds, and it's global financial assets, of which the largest global financial assets is debt. So yes, it rests on the debt thesis, but you have debt, then you have real estate, then you have equities, all summing up.
Break that down for us.
Sure. The total global financial assets in the world today are 900 trillion US dollar equivalent, okay? Which includes global financial debt, 400 trillion US dollars. Right below that, 300 trillion of global real estate. Below that, 100 trillion of global equity. And then there's a catch-all bucket of another 100 trillion, which includes your gold, which is anywhere between $5 and $10 trillion. It includes commodities. It includes all currencies. So adding it up, 400 plus 300 plus 100 plus 100, that's your $900 trillion of total global financial assets, okay? That's your addressable market for Bitcoin, measured in US dollar fiat today. Let's play some games. What if Bitcoin gets a 5% market share? 5% of 900 trillion, 45, do the math, 45 trillion, right? What's 45 trillion divided by the fixed supply of Bitcoin of 21 million? Over 2 million US dollars per Bitcoin in today's dollars. I don't care about anything else. I own Bitcoin for the next 20 years. If you ask me how it gets to my price target, I don't care.
How does it get to 5% of total?
Because it's the world's best store of value based on math and code that cannot be manipulated by any centralized authority. Start at 1%. Because right now, it's at $500 billion, or $0.5 of a trillion dollars, on 900 trillion in total. Gosh, it's so minuscule, and it could be so huge.
Let's focus on this idea that you said all fiat is programmed to debase.
Yes. It starts with the debt spiral, right? The only way to solve this spiral is by what's called an error term. you can't possibly generate the tax revenues to keep up with the organic growth of the debt spiral. That means you have to plug the equation. Otherwise, the left-hand side of the equation doesn't equal the right-hand side of the equation. So when that happens, you have to plug it with an error term. I call the error term printing money. Let's talk about the debt ceiling quickly. It is political theater. How many times has it bumped up against the limit and then they fix it only to come back to have to adjust the limit down the road? Now look, I'm betting, it's not certain, but most likely that they do solve the current debt fiasco.
But we're going to printing. I mean, that's
that's fair. Yeah. But they have to be able to print, essentially. Yeah. Here's the flip side. We're going to be back at the table in less than 8 months because $1.5 trillion will do nothing because that'll get used in less than 6 months. So we're going to be back at the table in less than 6 months, negotiating another increase in the debt ceiling. Ridiculous.
Foss calculations might be off for a few months, but his assertion that we would be back where we started discussing the same debt ceiling issue is completely accurate. During the weekend, President Joe Biden signed the bipartisan agreement to suspend the debt ceiling debate until January 2025 after the 2024 presidential election. That means in about 18 months, we will again be discussing the debt limit. Then again in another few years or even months. The debate certainly does not bode well for the dollar, especially at such a precarious time. According to Larry Fink, the chief executive officer of the world's largest asset manager, BlackRock, the recurrent debt ceiling drama jeopardizes the dollar's reserve currency status. Last week, while speaking at a conference, Fink noted that the United States is not properly positioning itself as a global leader as a result of its many economic challenges. During his discussion with Macquarie, Foss shares similar sentiments as he discusses his outlook on the United States economy, bonds, and the banking crisis. Here are more clips from the interview.
Look, I spent my entire career in bonds. Bonds make sense at a certain price. They just don't make sense at today's price, given where inflation is, but more importantly, where fiat debasement is, because bonds are a fiat contract. Don't ever forget, a bond is a fiat contract. And if it's priced in something that's debasing, I'm not arguing that it's highly likely that you get your $100 back. You lend to the USA $100 today for 10 years. It's highly likely, not certain, that in 10 years you get your $100 back as well as the contractual payments of interest. The problem is in 10 years, that $100 is worth $60 because of fiat debasement. Yeah, it's not a great investment because everyone runs the math as I invest 100 and I get 100 back and I get my coupons, and that's called a yield to maturity. But they assume that the value of $100 in 10 years equaled the value that it was today.
So not taking into account
debasement, correct,
and inflation.
They're the flip side. They're the same thing. But at the end of the day, yes, you're absolutely right. Now look, a bond is what's called a soft asset. And there are other hard assets. I know you like gold and real estate and Bitcoin. That's why I like being on your show. Because I'm not saying you have to put all your money in Bitcoin. But be careful of soft assets, which are bonds, versus hard assets that maintain their purchasing power against fiat, like real estate, like gold, like equities. Amongst those three, bonds are the worst. Now, in a short-term trade, guys can say, hey, interest rates are going to go down, therefore bond prices are going to go up. That's a trade. That's not a 30-year investment. I'm talking 30-year investment horizon.
Last time we spoke was right after Fed Chair Jerome Powell tried to assure us that the banking system was, quote, sound and resilient. Calm before another storm?
In my opinion, yes, only because banking is banking. The reality is banks are very levered. They always have been. And when you are very levered, which is to say that their capital base is only 4%, plus or minus, to their total asset base, that 4%, which is your protection, can get vaporized very quickly, which means banks are frequently insolvent. And having worked at the largest financial institution in Canada in 1988 during the Latin American debt crisis we talked about, different crises that I've been through, the Royal Bank of Canada was insolvent in 1988, but it was no different than Chase Manhattan and Manufacturers Hanover and Bankers Trust in New York, because the value of their loans, the Latin American loans, had fallen by so much that the equity value, the risk-absorbing equity in the bank, was vaporized. That's not healthy, but it is the fiat system. That's how it works. You know, did you see that UBS, which rescued Credit Suisse, is complaining that they said we were forced into this deal?
Yeah.
Well, they still did it.
Free market, yeah.
They still did it.
Yeah.
JP Morgan may be the last bank standing. Now, I agree. First of all, Jamie Dimon is a very good banker, but that's like saying, you know, you're the best of a very bad bunch, right? Like, banking is extremely risky, and he's a very good risk manager, but when you're dealt a hand that has 25 times leverage in it, which is what a bank is, it's very hard to thread that needle all the time. 25 times leverage, to be clear, is your 4% equity capital on $100 or 100% equity base. 25 times 4 equals 100. That's your 25 times leverage.
When asked about central bank digital currencies, Foss had a different perspective compared to other popular Bitcoin advocates. The former risk manager believes that CBDCs will be a plus and not a limiting factor to the growth and development of Bitcoin, especially in the United States. Foss believes that forcing people to use CBDCs, which will employ the same underlying technology as Bitcoin, will help to educate millions of investors about the leading crypto asset. He also believes that as people denounce the control and manipulation that will be available with CBDCs, they will be more open to investing in Bitcoin, a leading digital asset, which has all the good qualities of CBDCs without any of the control and manipulation. What are your thoughts on Foss' discussion with McCrory? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.